Do you feel that 2020 should just get in the bloody bin? If that's you, then chances are that you've had two key things at the forefront of your mind this year: COVID and the economy. But here are some hard economic facts. US GDP grew at an annual rate of 33.1% in the third quarter of 2020. Also, earlier this year, state personal income actually increased by 34.2%. These stats seem to be completely at odds with what's being reported in the mainstream media. All that doom and gloom about unemployment and lockdowns? The hard numbers actually say that the US economy is doing great. Yes, that's a bit of a head-scratcher. So, what the heck is going on here? My name is Guy, and today I'm going to explain why the pandemic's impact on the economy isn't what it seems. I'll also share my thoughts on what that might mean for Bitcoin, and explain why COVID may actually supercharge crypto markets. Before I get going, my overpriced lawyer has insisted that I say a few things. Firstly, I am not a financial advisor. Sorry folks, just not my MO. Everything I present over here at the School of DYOR is educational only. With that drivel out of the way, I want to take a moment to welcome anyone stumbling across my channel for the first time. Welcome one and all. Since this pandemic began, I've hunkered down here in the Coin Bureau nuclear bunker and have focused all of my attention on producing top-notch crypto content. If you want to be a part of that crypto train, then grab your ticket right now by smashing that subscribe button down below. Oh, and don't forget to ping that bell while you're down there. Crypto markets move fast, so you don't want to miss any of my videos. Finally, time is money, so I've placed some useful timestamps below. Use them to jump ahead to the sections of this video that interest you. Good to go? Let's dive in. Recently, the Bureau of Economic Analysis released some truly mind-boggling third quarter figures for the US economy. You can see them right here. Yes, the world economy was shaken to its core in Q2 of 2020, with US GDP falling by a pretty alarming 31.4%. However, according to the US government, we have seen one of the greatest economic rebounds in history during Q3, with GDP growth increasing at an annual rate of 33.1%. But wait, that's not all. Perhaps even more perplexing is the fact that personal incomes by state increased at an annual rate of 34.2% in the second quarter of 2020. That's right, when the US was being locked down earlier this year, average personal incomes actually went up. Official Q3 figures for personal income by state have not yet been released at the time of shooting this video. However, we do have some numbers for September, and they make for very interesting reading. Personal income went up by 0.9%, real disposable personal income rose by 0.7%, and real personal expenditure increased by 1.2% in just a month. Those are some pretty damn impressive figures. To put that increase of 0.9% in disposable income into perspective, that's a $170 billion raise in incomes just there. So, I hope all those numbers provide some insight and comfort for those of you who are freaked out by those scary headlines. Headlines like this one that claims that the unofficial US unemployment rate could in fact be over 25%. The data shows that Americans and many people living in other countries have never been richer. So, why not take a nice relaxing bath? Maybe switch on a soothing song. And while you're enjoying those bubbles, I will be telling you why the economy and fiat currency have been completely by the pandemic. A wise man said recently that this pandemic is just the UV light being shone to reveal a fundamentally broken economy. Let me unpack all that and explain why those economic figures I mentioned earlier are highly deceptive. To understand that, we need to go back to the second quarter of this year. That was a time when states throughout the US were issuing stay-at-home orders. The UK, Europe, and the rest of the world decided to hit the pause button on everyone's lives too. A time when toilet paper, PPE, and ventilators became the hottest commodities in the world. I'm sure you folks remember all this. It was indeed a scary time. With everyone locking themselves at home for weeks or months with their stockpiles of tinned goods and toilet paper, it's maybe not surprising that GDP tanked in Q2 of this year. So, how bad was it in the US? Well, that would be a pretty alarming 32.9% fall in annualized GDP. To put that into context, imagine if a company lost 32.9% of its value in that period. People would be freaking out, right? If those sorts of drops were seen in the stock market, then that would lead to a plethora of news headlines, no? Oh wait, it did. Here's the real scary thing. That 32.9% fall I mentioned refers to gross domestic product, which reflects the entire US economy. So that number is more concerning on a way wider level than just the stock market. To place that into perspective, the worst drop in a quarter during the financial crisis of 2008 was 8.4%. The GDP fall this year was apparently even worse than that seen in the Great Depression. Yep, that Q2 pandemic pullback of 32.9% could be the largest pullback in US prosperity since GDP was invented as a metric. In case you think I'm picking on the US, these falls in GDP were just as bad, if not worse, elsewhere in the world. Oh, and in case you're wondering, those are non-annualized numbers, so you can only imagine what the UK figure is when annualized. Now, I know that GDP numbers are not the be-all and end-all of an economy, particularly if they're due to black swan events like COVID. Besides, the US GDP has been on a tear in the third quarter of this year, and on the surface, everything seems to be all right. Here's why it's not. GDP is basically calculated using the formula: consumer spending plus government spending plus investment plus net exports equals GDP. The astonishing Q3 growth figures are largely thanks to a resurgence in consumer spending, which accounted for 68% of GDP. A couple of factors have made all that possible. The first would be the US opening up in the third quarter, and that meant people could pop to the shops and be good consumers. Personal consumption rocketed to 40.7%, while private gross investment rose by 83% amid a 59.7% increase on the residential side of things. Now, all that sounds amazing, but here's the deal. The GDP levels seen in Q3 of 2020 are still 3.5% lower than the figures seen at the end of 2019. That's after the biggest GDP increase in history. The problem is that there is a distinct trend of states reopening and then reversing that decision due to the continued spread of COVID. If that continues, it's going to be hard for consumer spending to keep on supporting that GDP growth in the fourth quarter. Another big problem is how all this consumer spending was made possible. So, the second quarter personal income increased by $193.4 billion versus the first quarter, and that was thanks to government social benefits. Yep, those crazy stimulus packages and checks you heard about. That all led to personal incomes going up by $1.39 trillion and personal savings hitting $4.69 trillion in the second quarter. Q3 saw personal income fall by a whopping $540 billion and personal savings drop by $2 trillion. Basically, what happened was that money earned from salaries has fallen during the pandemic. However, state transfer receipts have made up for that through a few things: stimulus measures, personal income from businesses, share portfolios, and income from outside of the US has also increased. Once the US opened up again, this meant that Americans had a bunch of savings, much of which was spent to fuel those Q3 GDP increases via consumer spending. The problem is that all this was only made possible through generous government stimulus measures that cost trillions of dollars. Indeed, that crazy stimulus not only made up for a lack of employment dollars, but actually surpassed it. Now, the trend is towards states imposing more restrictive measures to curb the spread of COVID. So, it seems unlikely that consumer spending is going to save the day in Q4. However, all this does kind of prove the theory that consumer spending rebounds if the government is generous with those stimulus measures while the country reopens. It's also got to be pointed out that the way personal income is calculated in GDP figures means that it skews very much in favor of the wealthy. I mean, how many people have hefty business incomes from outside the US, and fat share portfolios. All those income figures are just averages, and in a world where the 1% seem to be just gobbling up the lion's share of the assets and wealth, those averages can be super misleading. When it comes to net exports, things are not looking that great either. I mean, check out the graph here. It doesn't exactly paint a pretty picture, does it? That fall isn't exactly surprising when you consider all those coronavirus travel restrictions. It also means that the US is exporting less, and that means fewer people in employment. What all this data is telling us is that during times of coronavirus restrictions, people are spending less on goods and less on services, and people are stacking up savings thanks to that COVID stimulus money. Admittedly, that is probably only a position that the upper middle class or wealthy are in. However, this is what the data shows us. We just have to be aware that an average is nothing more than, well, an average. All that means that if the government decides that it wants to continue with all this stimulus, that a minority of people could come out the back of COVID with a stockpile of cash. So, now that we know what the official US government figures are telling us right now, let's take a look at what all this might mean for the future of the US economy. Now, when this all blows over, the chances are that there are going to be a ton of people that go out there and try and get themselves a job. However, perhaps some of you folks watching this still have a job, have spent less on services and goods during the pandemic, and have built up some savings, with a bit of help from those stimulus checks. I sure hope so. If that's you, then I imagine you've promised yourself a nice vacation or something like that. All that spending adds to GDP, and that means that the overall GDP figure should come back in time. But here's the bad news. All these stimulus programs cannot last forever. If they do, you will get crippling national debt. There's also the risk of hyperinflation, which could happen if economic output does not keep up with the rate at which the money printer goes brrr. It is true that if everything else remains equal, US consumption will bounce back, and the economy will be saved by people buying those overpriced lattes again. However, that assumption of everything remaining the same is not always a wise one to make. So, what is not going to remain equal? Well, for one thing, government stimulus is highly unlikely to last forever. Indeed, most governments around the world have set end dates for those coronavirus support schemes. In the US, the $600 a week federal unemployment benefit ended on the 31st of July, and no other scheme has yet replaced it. That's all coincided with the end of mortgage relief periods and means that many people are having to dip into those savings to keep a roof over their heads. This is reflected in the fall in personal savings rate seen in Q3. Finally, investment did see a resurgence in the third quarter, but that came after a crushing fall in the previous quarter. It turns out that it's hard to get a startup funded when there are a load of COVID restrictions and people are panicking. Who would have thought it? That results in a boatload of cash just sitting there doing sweet nothing. Normally, if people save money, then financial institutions like banks use that money to make investments. The problem is that these banks don't seem to like the idea of investing that money and pumping it into the real economy when people are fearful of COVID. However, if all that money on the sidelines flows into widespread circulation quickly, then that's going to cause inflation. Then you have what's called demand pull inflation, which happens when there is a rapid growth in, well, demand. To explain that, let's take a posh agri-tourism business. Right now, the chances are that these businesses are either closed or being run on skeleton staff. After all, how many people are willing to spend over $1,000 on a frivolous weekend away right now? Even if they want to do that, restrictions in some states might mean that this isn't even allowed. So, instead, households are likely to defer that weekend away and save that cash. Even better, those still in a job are likely saving even more money by not having to commute to work and banking a stimulus check or two at the same time. When everything goes back to normal and lockdowns are a thing of the past, that couple might decide to book that weekend away and enjoy a bit of agritourism. Here's the problem though. They may find that this nice little getaway is fully booked for months, as everyone else has had exactly the same idea. The only nights available could be at a massive cost premium. This is because of not only that surge in demand, but also due to a fall in the supply of agri-tourism businesses. Many tourist businesses just went under in the pandemic. All that means the surviving businesses can charge way more money. Take that simple example and apply it to every service out there, and I think you see the problem. Inflation could become a real issue. In a similar line of thought, when things go back to normal, wealthy individuals and institutions could think it's safe to invest again. They'll find that only a few investable businesses still survive. Chances are all those zombie companies will be out of business. So what will happen is that these institutions will likely drive up the price of what would be a meh investment to mind-boggling levels. Here's the deal. Institutions will have to buy into these iffy investments because they have too much cash on hand and they don't want to sit on it due to fears of inflation. On top of that, you have something called cost-push inflation. That's probably very likely to happen. What we've learned in 2020 is that if a pandemic comes along, then this is damn disruptive to global supply chains. That's likely to lead to a reshoring trend, with businesses looking to shorten supply chains and protect themselves from future disruption. Also, given the geopolitical tensions between China and the US, trade policy is likely to further favour local manufacturing. The problem is that domestic labour is more expensive, and that means increased costs of production. These are then passed on to consumers in the form of higher prices. With all this in mind, I hope you can now see why I think all this COVID stuff is highly likely to lead to astronomical amounts of inflation in the future. So, that leads me on to the subject of how people might protect their purchasing power from all of this. So, let's take a look, shall we? Alright, so the first safe haven asset that springs to mind would be gold. For years, it's been considered as a store of value, as the government cannot just print more out of thin air. Also, its value is not impacted by interest rate decisions, and it has that reputation for serving as an insurance against negative economic events. Honestly, I quite like gold as a hedge against inflation. However, it does have some drawbacks. The first is that it's not exactly divisible. Sure, you might only want to buy that carton of milk. However, it's hard to get change from that 100-gram gold bar. Practically, it's pretty damn hard to use gold as a currency these days. There is already an issue with people faking gold or inserting metal cores into gold bars. So, counterfeiting is a concern too. Then there is the fact that gold doesn't have a known supply. Just a month ago, $76 billion worth of gold was suddenly discovered in Siberia. So, yep, that increase in future gold supply is certainly going to have an impact on the gold price. Finally, you have the problem that, in a post-COVID world, it wouldn't be surprising if governments were not exactly keen on the idea of people jumping on planes with suitcases of gold to start a new life in a more promising country. That sort of capital flight would not be good news for the economy. We've already seen governments pre-COVID impose capital controls to stop this in places like Argentina and China. One major drawback of gold is it's pretty difficult to smuggle it through airport security and travel freely with it around the world. So there are a ton of drawbacks to gold as a safe haven asset. A safe haven that you may view as an insurance policy against pandemic-induced inflation. However, I honestly think that Bitcoin solves all those problems and therefore acts as a superior store of value. I mean, each Bitcoin is made up of 100 million Satoshis, which is pretty damn divisible if you ask me. It also cannot be counterfeited. The supply is capped at 21 million, and so that means you know that someone isn't going to discover an additional million Bitcoin hidden in the permafrost. Bitcoin also isn't controlled by governments or central banks, so it's a hedge against government and central bank incompetence. Also, when it comes to capital controls, I'd like to see any government try to stop capital flight when you can memorize those seed words, hop on a plane and access your funds anywhere in the world. Sure, a future government could turn their country into a glorified prison camp, But that seems a little far-fetched even in these times. So, if COVID really does usher in a new age of inflation, don't you think that there will be insane demand for such an asset? I sure do. But who are the types of people that would benefit the most from hard assets like Bitcoin that are inflation resistant? Well, that would be millionaires, of course. After all, they have significant purchasing power to protect. Here's the deal. According to Credit Suisse's latest global wealth report, there are about 52 million millionaires in the world right now. That's right, there is less than half a Bitcoin for every millionaire in the world. That means that if there is a mad scramble for Bitcoin as a safe haven asset, we could really be talking about some absolutely mind-boggling valuations for Big Daddy Bitcoin. Then you have corporations too. The really interesting thing is that some corporations may already be thinking ahead and have already acted to hedge out this pandemic inflation risk. You have Square that's invested $50 million into Bitcoin. Asset manager Stone Ridge Holdings, who have admitted accumulating 10,000 Bitcoin, and MicroStrategy that has acquired $425 million worth of the crypto. These are stock market listed companies that are buying up Bitcoin as a treasury reserve already. I covered this in much more detail on my video on corporate adoption, which you can watch right over bang here. With everything that's going on in the world right now, I doubt they will be the last corporations to take a position either. Now imagine a world where many of the world's largest corporations and millionaires are all competing with each other to get a piece of that finite supply of Bitcoin. What do you think one Bitcoin would be worth in this instance? I'll wager a heck of a lot. Forget the moon, us cryptonauts will be chilling on Mars. Okay team, that's about all I have time for today. However, I do want to share a few closing thoughts. Few would quibble with the idea that we're living through one of the greatest economic upheavals in modern times. This pandemic has forced most world governments to impose some really extreme restrictions, which are, frankly, terrible news for the economy. Let's be honest, people won't stay at home if they've no money to put food on the table. That's why I believe that for as long as lockdowns are a thing, that money printer will keep on printing and the wealthy will continue to stack more cash. As I explained, that probably won't end up too good when it comes to inflation. I do want to share a sobering thought though. Did you know that the average lifespan of a fiat currency is 27 years? And that we are in the 47th year of our fiat US dollar experiment? So, with the economic upheaval that's happening with this pandemic, this could truly be the time for a new monetary system to rise from the ashes. If you ask me, the future is bright. The future is crypto. Finally, if you've learned a thing or two from this crypto wizard, then send some love my way by smashing that like button. If you want to see more of me on YouTube, then don't forget to subscribe.